Okay, we're almost about halfway through 2021, which alone is scary. But what I want to do is talk about how inflation is really impacting the markets, not just the stock market, but all the markets, and what it's hurting the most, what it's helping the most, and how you can think about maybe structuring or positioning your portfolio so, in fact, inflation helps. Hey guys, this is RC Peck, and I want to talk about inflation. Now, specifically, I want to talk about three things. Number one, how it impacts equities. Okay. Number two, where it's going to help equities the most, right? So what part of equities is going to help, what part it's going to hurt. And then the third thing is what other assets is inflation going to help. So let's jump over to the price charts and let's talk about inflation. So let me jump over here. Okay, so I'm just going to look at inflation through the lens of the yield of the 10-year Treasury. And if you look at the screen, this is a 3.5-year price chart. And down here is just the S&P index. So the first thing I just really want to point out on this chart is there was a double bottom on the 10-year, the yield of the 10-year Treasury, and let's call it a 0.5%. So in March of 2020 and then in August of 2020, literally the yield on the 10-year Treasury was a 0.5%. You give the government $1 million and they give you back $5,000 a year for 10 years. Not that good of a deal, but that's what the deal was twice in 2020. So the second bottom was the beginning of August until today. And so what I want to do is I want to look at the different I want to look at different sectors, there's 11 sectors, and just look at from August of last year until today, what has done best? Because the second thing I want to talk to you about is what sectors have been impacted the best. Now, before I get to that, let me finish this first thing. So below here is the price chart of the S&P 500. So looking at the bottom price chart between the two blue vertical lines is where the 10-year yield bottomed for a second time at a 0.5%. So if we just kind of casually take that to where it is today, the stock market's up 27%. This is just the index, so there's not dividends included. But yields going from a 0.5% to 1.5%-ish, the S&P went up 27%. So clearly in this time frame, what we're looking at right now is interest rates going higher, stock market going higher. That's what matters most, is what's happening right now in this environment. So the first answer is, hey, stocks are going higher. Specifically, U.S. stocks are going higher. I'm not saying international are going lower, but U.S. stocks are still outperforming international stocks. So the first question is, how is it going to affect the stock market? And the answer is, this time around, it's positive. Now, if we get into hyperinflation or something more, it may impact it differently, but we are nowhere near hyperinflation. We literally have just gone from a 0.5% on the 10-year to 1.5. That's probably more re-inflation than anything else. Now, before we go on to number two, which sectors are helped best, I simply also want to point out that the yield on the 10-year has really been bouncing between 1.5 and 3%. So until the yield on the 10-year gets above 3 and stays above 3, you cannot talk about hyperinflation or anything scary like that. Right now, we're just at reflation. There's re-inflation going on around the yields. Okay, so that was the first thing. The second question is, what sectors are being impacted positively or the best? So here is a screen. And this goes from the beginning of August of 2020 until this week, June 4th. And there's 11 sectors that make up the U.S. stock market. Now you can see there are four tall buildings here. Financials is up the most. So it's up 33% since the second bottom of yields. So let's call it since inflation has taken hold, since inflation is moving higher, August of last year. The best performing sector is financials. Right behind that is energy. So financials are up 33.5%. Energy's up, call it 28%. Materials are up 17%, and industrials are up 18%. So of the 11 major sectors, the top 3 sectors are financial, energy, and industrials. Okay, so right away we go, okay, What matters most is what's happening right now. And what's happening right now is yields are increasing on interest rates. Okay. Okay, well then where does money want to go? Where's money being treated best in the stock market? The answer is financials, energy, materials, and industrials. Now the funny thing or the odd thing or the interesting thing about all four of those, they've been dead for a decade. They make up very little of anyone's portfolio, right? Materials, industrials, energy, financials. Think of the last time a pick of the month newsletter or a talking head on CNBC was like, yeah, we got to get into these left for dead parts, sectors of the market. But that's actually what's been going on since August of last year. And what's interesting about that, the way you could categorize these four sectors is value. So value is on, growth is off. So the second question I said that I'm going to answer in this update is, hey, how's it affecting sectors? What sectors are doing well? What sectors are doing bad? If you look at what sectors are doing the worst, just go look. Utilities are down 15% from that time period. Healthcare is down 11%. Staples are down almost 12%. So at the same time, you can learn where to stay away from, what to stay out of. Okay, now I want to talk about the third thing, which is what else is going well? What else is doing well other than equities? And the answer is commodities. So let's see. I'm just going to take energy off of here and just put in, DBC. So I'm just going to type in DBC. We're going to get this big messy mess thing here. And I want to go back to about the same time period. So we have the same four tall buildings. We have financials right here. Slightly different time frame, but let's just go with it for right now. You still have financials in first, energy in second, industrials in third, materials in fourth. But notice here you have commodities, and commodities are a non-equity. Now, the reason I bring this up is because anytime you can get equity-like returns in a non-equity, and by the way, during the same time period, the S&P is up about 30%, not quite 30%. So you have commodities outperforming equities, equities being measured by the S&P 500. That's pretty important. So anytime you can get your money outside, because this is the type of diversification you want, right? So you have exposure to commodities. It's not equity. There's very little correlation, right, between equities and commodities. But what we have is over the exact same time period, you have commodities up 44%. And so it starts to tell you where money is flowing, where money is treated best. So here's the wrap. Okay, so number one, stocks can absolutely go up when interest rates go up. It's happened in the past. It's not uncommon. It's when you get hyperinflation that's going to really hurt stocks. We're nowhere near that. And so number one, stocks are moving higher and interest rates are moving higher. Let's just call that inflation in yield. Number two, what is being affected positively in the stock market? And we had that answer. Financials, energy, industrials, and materials. And materials and energy are pretty much the same thing. Industrials, maybe is the odd one out from those two. But that doesn't mean you should be in financials. There's probably parts of financials, regional banks, whatnot, that are doing even better. Hint, they are. The same thing goes for energy. There's parts of energy that are doing better. Exploration and coal are doing much better than the core sector it's part of. So number two, what is doing best? Financials, energy, industrials, and materials are doing well. And then number three, what outside of equities is doing well? Commodities, guys. Commodities are moving higher. Commodities, by the way, have been dead for a decade also. So now you have five things. You have industrials, materials, energy, and financials that have all been dead for about a decade, and also commodities. All the parts of the market that have been dead or quiet or in a downtrend have now woken up and are moving higher. So when you get hit with this information that inflation is here and hyperinflation and CPI and core CPI and blah, 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 the takeaway is, what's price telling you to do? Follow price. Because guys, there's three things to have your portfolio move faster and have it be easier to make money. And it is understand price, understand where strength is, and understand what those signals are. I appreciate you guys being in my world and watching this video. If you like this, please leave a message or leave a comment or hit the like button and let me know where I'm right, where I'm wrong, where I'm missing something, where I'm completely off. I read the comments. This is my only social platform that I use. Also too, guys, if you like this video and you want to have your portfolio move faster, grow faster, and have it be easier, then check out Clarity and Control. It's my free course that shows you exactly what is probably missing, even if you've been doing this for 10 or 20 or 30 years. Thanks, guys, for being in my world. Thank you for watching this video, and I'll see you on the next one. Okay, bye.